today we are talking about balance sheets. So first let's talk about who is wealthier, Ian or Mitchell. Ian has an income of $30,000. Mitchell has an income of $85,000. And if we solely looked at their income, we might say that Mitchell is wealthier. But if I tell you that Ian has a net worth of $50,000 and Mitchell has a net worth of $35,000, that might change your answer. So we're going to learn more to be able to actually answer this question, talking a bit about net worth today. So this is important, write this down. Net worth is the measure of financial wealth. And wealth indicates the monetary value of all possessions that a person or household owns minus the total amounts owed to others. Or to summarize that, wealth is what you own minus what you owe. What you own minus what you owe. So net worth versus income. Net worth depends on how a person manages their income, and income is just the money that you receive from wages earned from working for pay. A person may have a high income and a low net worth, or vice versa. So you could have a low income and a high net worth. Income is not necessarily related to your net worth. Net worth has to do with everything you own minus everything that you owe. How do you determine what your net worth is? So you're going to do what's called a balance sheet. That is a financial statement that describes an individual or family's financial condition on a specified date by showing assets, liabilities, and net worth. On the right here, you see this is an example of a balance sheet. It's also the example of the template that you will get. Balance sheet shows a person's net worth. It is similar to what's called a statement of financial position or a net worth statement. There are three components to a balance sheet: the assets, the liabilities, and the net worth. Up here is the assets. I'll put a circle around assets. Down here is liabilities. Put a circle around liabilities. And down at the very bottom is the net worth. So put a circle around net worth. Those are the three components: assets, liabilities, and net worth. You'll notice that assets is broken down into three subcategories: monetary assets, tangible assets, and investment assets that we will talk about separately. You need to know which category assets go into. So you'll be given a list of assets and you'll have to put them in the correct category when you construct your balance sheet. So what is an asset? An asset is everything a person owns with monetary value, like cash or the value of personal possessions. Monetary assets is one of the subcategories, and monetary assets can be quickly and easily converted into cash. So it's basically like quick money, like actual cash, or the money in your checking account, or the money in your savings account. All of those are examples of monetary assets. Monetary means money, things that are quick cash. Tangible assets are a second kind of assets. Tangible assets are personal property that was purchased to create a lifestyle or improve your life. Sometimes they're also called lifestyle assets. They're things like your home, your car, your electronics, and your clothing. So tangible, think of things that you can touch. Pretty much if it's something you can touch, right? Like it's a thing, it's a piece of property that you own, that's a tangible asset. So how do you determine the value of your tangible assets? So like, how do I determine the value of, say, my clothing or electronics? You're going to look for what's called the market value, and that's what you could realistically sell that asset for today, not what you originally paid for it. This is the amount that you list on the balance sheet, the market value, not what you paid for it. So where do you find the market value? Websites are available to estimate the value of things like cars. So I would research the place you would sell the item to determine what similar items are selling for. So if it's electronics or clothing, wherever there is a place that people would normally sell those things used, go there, find your item or a similar item, and then that's the amount that you would end up putting in the balance sheet, not what you paid for it. So let's look at an example. Derek purchased a car for $12,000 2 years ago. The current market value of his car is $8,500. So he would put $8,500 in his balance sheet. So investment assets, these are purchases made for the purpose of selling later at a higher value or for income in retirement. They are things like your 401k or IRA, your retirement account, stocks, collectibles, okay? Like collectibles are kind of like a tangible item, but you're purchasing it for the sole purpose of it to go up in value. So it goes under your investment assets, collectibles do. So what are liabilities? This is your next category, your next major category in your balance sheet, right? You have assets and then you have liabilities. And liabilities are a debt or obligation owed to others. Things like a mortgage, which is a loan for a house, or other loans for like a car, student loans, or the balance on your credit card, or if you borrowed money from a family member. Those are all things that are liabilities. All right, what is recorded in the liabilities section? So it's the amount you owe if you were to pay the amount owed in full today. So let's look at a car loan. So let's say you're paying $180 a month. And if monthly payments are continued to be made until the end of the loan and you have it paid off, if that total of all the monthly payments was $6,300, but if you paid it in full today, that amount was $5,490, then you would record on your balance sheet the $5,490. Here's why. That $6,300 is all your monthly payments added together. Your monthly payments include the principal or the amount you borrowed plus the interest. If you were to pay it off in full right now, pay it off early, you only have to pay the principal. You don't have to pay the interest, which is why you can save money by paying off a loan early. So the principal is the amount that you owe, and that's the amount that goes on your balance statement. It's just the amount that's left on the balance of your loan, not the amount of if I added up all my payments until the end of the loan. So liabilities versus expenses. So liability is money owed to others. Expenses is just money that's spent. So the characteristics of a liability is that it's a total amount owed, and an expense is bills that are paid on a regular basis. For example, your car loan, the $5,490 that's owed, that is a liability. Your monthly payment to repay the car loan of $180 a month, that is an expense. So for example, if you go out to eat at fast food places, that's an expense, not a liability. It's not something that is currently owed. It's just something that you would pay as a normal course of life. So that's the difference between liabilities and expenses. Liabilities go on your balance sheet, expenses do not. They go onto a different kind of document. Calculating net worth. This is super important. Net worth is assets minus liabilities. All the stuff you owe minus, all the stuff you own minus the stuff you owe. Whoops. Go back here. So make sure you get that. That is a super important concept. Net worth is assets minus liabilities. So think of your net worth as your personal financial thermometer. It's really kind of a number that objectively measures your financial temperature, kind of lets you know how you're doing. So you determine what amount of net worth you desire, and then you set goals to reach that amount. How can you increase your net worth? So basically, you're going to evaluate how you manage your money, and the way that you increase your net worth is you can increase your assets or decrease your liabilities. So increase your assets or decrease your liabilities. That's on that second page of your notes. How can you increase net worth? Increase assets or decrease liabilities. So you have 3 money management tools that work together to help you manage your money and therefore increase your net worth. The first is the balance sheet, and that tells you your financial position today. Then you have your cash flow statement that tells you how you have managed your money in the past. And then you have a budget. That is what your future money management plan is. So they work together to help you objectively evaluate your past, present, and future financial decisions. That's how you reach your net worth level that you want. Your present self impacts your future self. So you need to keep your net worth in mind when making financial decisions. And the reason that you should do that, which is the next box on your notes, is because your present self influences and impacts your future self. So how will this financial decision affect my future net worth? So the things that you do now affect where you end up in the future. So by keeping your net worth where you want to be in mind, you will make better decisions in the present to be able to get you to that goal. So who is wealthier here? Let's look back at Ian and Mitchell. So here's Ian's balance sheet. He has total assets of $95,000, total liabilities of $45,000, and a net worth of $50,000. Mitchell's balance sheet, right? He has total assets of $147,000, total liabilities of $112,000, and total net worth of $35,000. So let's real quickly kind of take a look at some of the differences. Ian's house is worth $60,000. Mitchell's is worth $100,000. So Ian's is worth $60,000, but he only owes $40,000 on it. Mitchell's is $100,000, but he owes $80,000. Their retirements are about the same. Savings, Mitchell has a little bit more in savings. The car, Ian's car is only valued at $10,000, Mitchell's is valued at $20,000. Let's look at college loans here. Ian only owes $5,000, whereas Mitchell owes $20,000. Ian has no car loan. Mitchell has a car loan for $10,000. Ian has no credit card debt. Mitchell has $2,000 in credit card debt. So that ends up meaning that Ian's net worth is greater than Mitchell's net worth, even though Ian makes less money. So, do you think Ian is making any trade-offs to have a higher net worth than Mitchell, even though he has a lower income? He is. His house is worth less, so maybe he has a smaller house. His car isn't worth as much, so maybe he bought an older car. So get some other trade-offs. We'll go back here. Right? So his house might not be as big. His car maybe is not as new. His college loans, he has less in college loans. So maybe the trade-off to have a lower amount of student loans that you owe is that maybe he worked while he was going to college. Maybe he took longer to finish so that he could pay some of it off as he goes, so he didn't have to take out so much in student loans. That's a trade-off, right? I can either finish with college really quickly and get a lot in student loans, or I can take the trade-off of taking longer to finish, working part-time while I go, but I have less in student loans. Ian doesn't have a car loan. So maybe the trade-off was that he waited longer to get the car and saved up more money and was able to pay cash. Or he got an older car, so he didn't have to take a loan. Ian doesn't have any credit card debt. Well, what's the trade-off? The trade-off is that sometimes you have to wait to buy something. I can't buy what I want right now. I have to wait. For example, my husband and I found this kitchen table that we really loved. We couldn't afford it at the time, so we saved up for a year, went back and paid cash for the table rather than going into debt for it. That was a trade-off. How could both Ian and Mitchell increase their net worth? Again, the way that you increase your net worth is you increase your assets or decrease your liabilities. If Ian and Mitchell were thinking about going on vacation, how would their statement of financial position guide their decision? If their net worth is not where they want it to be, they might choose to go on a vacation that is worth less money, or they might choose to hold off on a vacation and save up for it so that they don't have to go into debt. So when would a person need or want to create a balance sheet? This is the last section on your notes. It is recommended that you do a balance sheet once per year. It must be written to be most effective. That's why you want a written balance sheet, because that's how it is most effective. If you just sit down and try and go over it in your mind, you're probably going to miss things. So seeing things written out in black and white is much more beneficial. You can use any written method that works for you. I'm giving you some blank templates that you can take with you, and so those would help as well. You would also want to do a balance sheet at special times in your life when you're making decisions regarding assets or liabilities. And you may have to create a balance sheet for a financial professional. So some of those big special times would be maybe when you're buying a house, or maybe when you're getting married or going to buy a car. Those are some important times that you should be making your balance sheet. So when is it recommended? Once a year, or in special times like buying a house or buying a car. So just to summarize, these are all the really important points we went over about balance sheets. So net worth is assets minus liabilities. Net worth is an objective measure of your wealth. Net worth is your financial thermometer to objectively measure your financial position. And to increase your net worth, you will have to increase assets or decrease liabilities.